calendars out. February 17th, February 18th, live trading, San Diego. We got the Lowe's Coronado. I mean, what else would you want? This event is limited to 50 people. Look at your calendar, clear it, make sure you show up. If you want to be a rebel, this is the place to be. You got to sign up for it now. Giddy up, baby.
And we're back. It's been a couple of weeks, Stu. We were missed Thanksgiving, and then last week we had to cancel unexpectedly for our Miami event, which for those of you who have not been able to attend one of our RebelCons, tremendous amount of trading knowledge, so we hope you can join us in the future. We do have one coming up in Coronado in February, don't we?
February, right?
Yeah, that'll look good. So before we get started, I did compile a list of questions that we had from the last one. What do you suppose is the number one question that we got?
When should I sell?
No, that was number two. Number one is people want to know what happened to your hat. I told them it was either a weed-eating accident or leftover from the crash of '87. So what's the deal with it?
A little of both. It got ran over by a propeller on a boat.
Oh, that'll do it. Okay.
But I couldn't part with it, so it's just with me forever.
Yeah, looks like it belongs in the MoMA, Museum of Modern Art. We love it. So anyway, it's great to be back, and we do this every Thursday, 4 p.m. Eastern Time. And we've also decided to add a new little segment to our coaching session here that we're going to call Chalk Talk. So we're going to pose a question at the beginning of the session, kind of an intriguing question, and then we'll answer it at the end, give you a little incentive to kind of stick around to the end. So for today, Stu, what do we come up with? We have, let's say that you own the $100 call, stock gaps up to some number, doesn't really matter, but let's say it's up to 110 in the after hours.
Yeah.
And the problem is that a lot of times traders will say, oh gosh, if the markets were open, I'd love to close it right now. It's worth 10 bucks of intrinsic.
Yeah.
But I just can't. Options don't trade in the after hours. I'll wait till the morning. But then what happens?
Hate that.
Stock gaps down. It comes all the way back to 100 or lower.
There you go. And what'd you do? You missed a whole bunch of opportunities
Missed the whole
that
thing.
You could have locked in.
So the question is, how do you lock in the $10 gain before the market opens? There's a way to do that, and Stu's going to give us the answer there. It's a nice little trader's tool, and that's what we're here to teach people how to do to become better traders, make better decisions by understanding the perspectives of a market maker. And everybody knows you now, Stu, but 29 years on the Philadelphia Stock Exchange floor as a market maker and specialist. So lots of things that he's going to be.
Yeah, that would be me.
That would be you.
Yeah, and I walked away alive, so I guess
that says a lot. So today we took a little different tack. We had a different coaching session for you today, but we got a gift from the internet. And when these things kind of fall from the heavens, you have to take them. And there's a little puzzle that went around that apparently was really super difficult for people. And only 10% of the people got it right, which we found astounding, as did a lot of the people that left comments on it. So we're just going to call this unbelievable accounting errors. Sorry for the pun, but there's no other way to put it. It's just an unbelievable error. Now, depending on the story, many of you might have seen it, it was either done with horses or with cows, but it's exactly the same problem. And so let's see the problem, and then we'll show you what it has to do with options trading in a moment. So here is the cow puzzle that stumps the internet. I bought a cow for 800 bucks. I sold it for 1,000. I bought it again for 1,100 bucks, and I sold it again for 1,300. The question is, how much did I earn? So at the time that I saw this, believe it or not, there were 16 million views. I said it went viral, right? There were 16 million views, and only 10% of the people got it right. Now, to us, it seems to make sense, and hopefully to our options traders, but evidently for a lot of people, it doesn't. We've stumbled onto this in Q&As with traders that make this similar mistake. And if you don't know how to account for this, you're going to make very bad trading errors because you just don't know where you stand.
And I got to tell you, Bill, I didn't tell you this before. I actually threw this question out to some friends and family. And,
all got it wrong.
I got to tell you, like 8 out of 10 of them got it wrong.
There you go.
It was unbelievable that they got this wrong.
Yep. So again, this is why it's posed in a very simple format here. But when you start saying, oh, I bought this call, or I rolled it and I did this and I bought it and sold it, people get doubly confused.
Yeah.
So let's take a look at what the answer is, and then we'll show you where people made their mistake. So here it is. I bought a cow for 800 and sold it for 1,000. So right there is 200 bucks. Then we look at the second transaction. I bought it again for 1,100, sold it for 1,300. There's another 200 bucks. So that's 400 bucks, and that is the correct answer. Should be fairly obvious, but
how do you go wrong on that? I'm not sure how you go wrong on that.
90% of the people do. All right.
Keep it simple. Keep it simple. Follow the money.
Follow the money. But now we say that, follow the money, but where do people make the mistake? Here's what they do. They say, I bought the cow for 800, I sold it for 1,000, but then I had to buy it back for 1,100. And so what they'll say is, I lost 100 bucks here. Well, that's not really a loss. It's maybe a missed opportunity, but they look at those cash flows and say that it was 300 that I made. And this was probably the most
prevailing
common of the mistakes. Yeah, this was probably one that they got stumped here in the middle between the sell and the buy.
Yeah, it's just an illusion.
It totally is. Now, let me show you a couple of ways, little financial tricks you can do that will help you to solve problems like this. And that is to split it up. Pretend that it's two different people or that it's in two different accounts. And if you're coming up with different answers in two different accounts, it shouldn't be any different than if they're both in your account.
Still the same trades.
Still the same trades, correct. So let's say if you had a, I'm sorry, let me back up for a second. This is the double accounting error. I wanted to show this as well. Here's why this is not right. If you bought the cow for 800 and sold it for 1,100, that's 200 bucks. But now
sold it for 1,000.
I'm sorry, sold it for 1,000. If you sold it again for 1,000, that would be like a short sale. See, it's another opening trade. And then if you bought it back for 1,100, yes, in that case, that would be true that you've lost 100. You bought it again for 1,100, sold it for 13. In that case, that would be 300. But take a look at it from an options trading perspective. This is an opening trade. This is a closing trade. If you were to
open and close, done.
And that's done. But see, here's the mistake that they're making. They're assuming that this is an opening trade again. Now, normally we don't short cows, but you kind of have to use your imagination if you could. That would be a short sale. You bought it back for 1,100. Yes, that would be minus 100. We bought it again for 1,100. That's an opening trade. Sold it for 1,300. That's a closing. And then we would have these cash flows that would say it is in fact 300.
Looks to me like that's 3 trades, Bill.
Exactly right. See, they're double counting it. The people that make this mistake is that they're saying, well, I sold it and then I sold it again. But then they're counting it twice and they don't realize it.
Yeah.
So one reason for options traders that can help you to always remember what if it's an open and then a close, it's done. Those cash flows are done. So back to the little financial trick I wanted to show here is if we have two separate people. So let's say that the first person bought the cow for 800, sold it for 1,000. Second person bought it for 1,100, sold it for 1,300. Yes, both of them made 200. And if you can say, obviously combined, they made 400. Well, why would that be any different if it were all in your account? If you were one person doing both trades, you should get the same answer.
Not only should you get the same answer, you will get the same answer.
Well, evidently, that's true. We would hope. But this is, again, it's a nice little trick that you can use for a lot of cases in the markets. And people will say, well, what if we put them in two separate accounts? What if one trader did that trade in one account, somebody else did the second trade in a second account? You'd say, well, that's 400 bucks that were earned. Well, then why is that any different if it's all done in one account? So this is the way that you have to see the trades, or you are going to make gross mistakes, as we're going to show you in just a moment. And before we do that, as always, for anybody who'd like to learn more take your education to the next level, please check out marketrebellion.com/get started. All kinds of freebies in there, and even coaching packages if you'd like. So let's now see how our accounting errors correlate with the stock market. All right, so here's the question. How do you track your cost basis? And I know you teach your students well about this because it is critically important. What is it that you show them? It's a very simple way.
Well, you got to know where you're starting from. How much are you spending?
Right, so let's say that we track the cash flows. You buy to open for $800.
Right. And then when you sell it, there's an amount of money coming in. So you're tracking money going out, you're tracking money coming in, and the net difference is going to be where you are as far as your P&L.
Right. So going back to the cow problem, if we bought to open for 800, sold it for 1,000, bought to open for 1,100, sold it for 13, that's a net of 400. And the way that you get that is just combine all those greens and reds together, combine them.
23 and what's that? 19, $400.
Yeah. So then the other thing that you have to do though, and this is where traders also make a mistake, are there any positions open? So take a look at
which is really just unrealized versus realized.
Correct. But they will do this. They'll say, okay, well, I've still got maybe with a roll, they have an open position. They think, well, now I've kind of locked this in. Well, it's not really locked in because you haven't fully closed the position yet. But in this example, what did we get? Open, close, open, close. We're done.
We're done. There's no positions left to have a mark to market on. You're done.
Correct. But let's say that we had purchased a new one. Maybe we purchased the cow for 1,500 again. What's our net? Well, you'd have to be careful. Yes, we have a net 400 cash right now.
Yeah.
But we have an open position that could still go against us. And this is where traders will forget about that and make some bad risk management errors.
Is that why the option gods put in the column mark to market?
They put in mark to market, which is typically going to be the midpoint, showing you what that position is worth.
The midpoint between the bid and the offer. That's it. Unless you're Fidelity and they'll mark you on the short, they'll mark you on the offer, and the long will mark you on the bid.
On the bid. A lot of them do that to be more
scary, but yeah.
But it's a good way because it's always the current market price that is your risk. We've talked about this before. Traders will say, well, I only paid $2 for that option. It's trading for 20 right now. I've rolled it. I've got $4 out of it. So I've got a guaranteed gain. I can't lose. Well, that's not true. That's your money in there. You might have gotten your principal back, but you still have money at risk because you have an open position.
Look, the bottom line is you got to move forward. The markets move forward. You have to move forward. So what do you have now? Not resting on what did you have? What do you have now? The whole thing about, well, what did I make? What did I lock in versus what I have? That's all just conversation. Doesn't mean anything. Confusing.
That's exactly right. So the thing that we really want people to get from this is to just do this. Your opening position, assuming it's a long position, you had cash going out, minus 800. Then the closing position was cash coming in, plus 1,000. You decide to do another trade, minus 1,100, cash coming in, plus 1,300. And just get out your calculator, minus 800 plus 1,000, minus 1,100 plus 1,300, you're going to end up with plus 400. And then a final check is, do I have any open positions? In which case you'll say, okay, the trade's not fully done, but right now this is how I stand.
And, as a little side note here, look, many of you have seen this. This is typically AJ's blotter that he does in his service.
Yeah, exactly. Right.
He's just tracking the money in and out. What I'd like to do with my people is I like to suggest to them to add columns. Add a column for Delta, add a column for Theta and Vega, and just add different columns. Stock reference. What was the stock price? It teaches you to get a handle on what you're doing at what point and why. Stocks change prices. Options change prices. It helps you to connect the idea that you actually are trading the stock. You're trading the stock movement. You're trading the days that you're in the stock, and you're trading levels of pricing, which is implied volatility in the options. And at the end of the day, look, you're trading the stock, but you're trading it via an alternative vehicle that we're going to call an option.
Correct. Yep. And so that actually makes it a lot easier for people to follow. And I know this is why you're so adamant about teaching this. I do the same thing. We talk about it in Q&A all the time. And unfortunately, too many times traders just say, well, I'm just opening and closing stuff and I'm just trying to make a lot of money, but they don't understand where they are. And that's going to throw a wrench into the decisions. So
How can
another
you
question.
how can you figure out where you want to go if you don't know where you are?
It's a really good question. So let's
that.
answer it definitively here. Why is it so important to track the cost basis?
Oh, well, there you go. Because you got to know where you're going. I mean, you can't know where you want to go if you don't know where you are.
Right.
So you need a reference. You need a stock reference. Maybe you need a P&L reference at times, although that's a little bit of a slippery slope at times, but you got to know where you are. You got to know what your positions are. You got to know what your exposures are, your Greeks. These are all gauges on the automobile gauge, the speedometer, the tachometer, the oil pressure. These are all things that are telling you what do you have going on right now? What's your risk? How's your exposure working? And in order to facilitate the goal of where you want to be, you kind of have to figure out what you have now.
Where am I? Right. And unfortunately, all of the traders, and this is a very good message for all of you who might find this confusing or that your trades, you're not getting the results that you expected. This is a lot of the reasons right here. People don't know how to make that decision because they have excess amounts of risk that they didn't know because it was still an open position, or they didn't account for the roles correctly and they think they've got all kinds of money and in this quote unquote free position when they're really not. And we just realize if people can't account for 2 trades with cows, how are they going to do it after multiple rolls?
Here's a great example of like maybe when you have a diagonal spread on and the stock moves and you have to roll your short option.
Yep.
And you start looking for an option to roll into that is similarly priced to the option that you have to buy out of.
Yes.
And you're just kind of rolling through the next month looking for the dollar amount. And that dollar amount, if you missed your roll, is probably going to put you into a delta that you don't want.
It happens a lot.
That big dollars is going to, in order to find you that big dollars to roll for a net credit, hey, I don't really want to spend any money. You're going to wind up with a high delta, and that high delta versus your long option might just put you in the opposite direction that you
Negative
really
deltas.
think you want to go. Yeah.
Yep.
That's a
Very
big
good.
problem.
It happens a lot. And this
Happens
is
a
why
lot.
even with, and that's not really even a terribly complicated position. It's just one long and one short, and it
That's
can
it.
cause all kinds of problems for traders.
Yeah.
And this will greatly help you if you can at least understand
It's
where
not
you are.
tough. You just have to kind of know what to look for.
Right. However, as with all things with options, there's always these little nuances. So another question for you, Stu, where can this method fail? This method of saying we're just going to account for all the pluses and minuses.
How can it fail? Where can the method fail? Well, it can fail when I guess when you don't add them up right, it can fail. It could fail when you fail to close an option. And then the numbers start to become skewed because you're not looking at your mark to markets. It can fail when
What about your box positions?
Well, your box position lays out a net debit, but you're locking in a net debit at a lower price than the spread between. So if the spread between is like 5, maybe on a 100 versus a 105, and your net debit is a 4, you might think you got $4 at risk because you laid out 4, but you're paying 4 to make 5.
Exactly.
Which you're paying 4 to make 1 on 5, right? You're paying 4 to get 5, so that means you're going to make 1, and it's a lock. And if you're not paying attention to kind of what you have, and you're just looking at the dollars, saying, "Hey, I got 4 laid out here," but it's representing a $5 asset, then you got a problem.
Yeah. So you have to understand that this can happen when you start mixing calls and puts. So for example, let's say that you buy the 100 call. This is an opening trade. You spend 3. There's a little minus 3, but then you buy a 105 put to open. Notice we've got 2 opening trades. We have minus 4 into it so far. So that's our net cash outlay. However, what do we have here? A lot of traders will say, "Oh, I've got $4 into it. That's my maximum loss." Well, you've mixed your calls and puts. We have the right to buy at 100. We have the right to sell at 105. It's now a $5 box. So this is exactly what Stu was just talking about. It now returns $5. And again, that's because you have the right to pay 100, the right to sell for 105. So that's a guaranteed 5.
Hey,
for
Bill,
what you paid for.
Bill, let me ask you a question. Right?
Yeah.
If I gave you $4, if I said to you, give me $4, and I said to you, you're guaranteed to get 5 back, is that a trade you would do?
We'll do it. We'll do it all day long. And this is also kind of a curiosity why people will look at this and say, oh, but it's a debit. I'd rather roll for the $1 credit. Well, if you're rolling for a $1 credit, you could have also bought the put for $1. If you can roll for a $4 credit, which is what we usually show for the longer term options, you could have also bought the put for $1. Because
do we really want to open up that synthetic theory?
Locking in 5. Not right now, but I'm just trying to make the point that whenever you have to be careful with your debits and credits when you start mixing calls and puts.
You know what I say? Debits and credits are for accountants, man. It doesn't mean a thing.
Right. For trading terms, forget that. If you're an accounting major, yes, pay attention to it. For accounting, or for trading, it's completely meaningless.
This is 101. These are rights. This is what it all comes down to, guys. It's rights and obligations. You have a right to buy the stock at 100 and you're paying 3 for it. So that's 103. You have the right to sell it at 105. What are you paying for that? $1. That's 104. Right? You want to sell it at 104 and buy it at 103? You're going to make $1 all day long. Sign me up. I'm in.
Sign me up. I don't care if they're debits. So here's another reason why it can kind of backfire where people get mixed up is when you're tracking your rolls. So let's say that we buy the $100 call to open. We're going to spend 6. I sell it to close for 8, but then I buy the 105 for 4. Mm-hmm. So this is a net credit of 4 between those two. I'm just going to show them as 2 separate trades. Normally we would do that as a vertical spread.
Okay.
We sell the 105 for 7, and then we buy the 110 for 3. Again, a $4 roll. Mm-hmm. And so right now we have a net credit of 2. So do you see how easy it is? I spent 6, I collected 8, spent 4, collected 7, spent 3, collected 2. Or I could also say I spent 6 and collected 4 just on these 2 trades. And then I collected
all comes out to be the same money, doesn't it?
All comes out to be the same. Here I collected 4, and 4 is 8, minus 6 is 2.
Follow the money.
Just follow the cash. And then when we do that, here's what it looks like graphically. There was the initial 6. All right, we rolled for a $4 credit, and that was selling for 8 and then buying to open for 4. And so that $4 credit shifted us up from -6 to -2.
6 minus 4 is 2 all day long.
Yep, we sold that one to close for 7, bought this one to open for 3.
Yeah. How are you going to lose from there?
Right. Well, and you could, because this, or at least you might open up the doors to more risk than you were willing to take, because this is still an opening trade.
That's right. This is really cool. So look, if you now have a $2 credit and you now roll into something that's less than $2,
right,
you're not going to lose. It's impossible to lose on that note. But if you roll into something for $3 or $4, then you might lose.
Yes.
So as a risk management tool, maybe you say to yourself, hey, I got $2 in my pocket. Maybe I'll roll for something that is less than $2. And that way lock in a profit, no matter what happens, even if I ride that new puppy into the sunset.
Right. Sell half, roll half, all things we've talked about and we'll continue to talk about. But for right now, again, the thing that we just want to emphasize is how easy it is to figure out where you are by just using pluses and minuses. Yeah. It'll help you to track your options, and it'll definitely help you to track your cows, should any of you be wanting to do that. So
I gotta go count my cows. Yes.
So one final little note, remember, for anybody who wants to take their trading to the next level and learn really insightful tips like this and strategies, check out marketrebellion.com/get started. So Stu, with that, let's go back to our chalk talk for today.
Okay.
I know, I kind of forgot about it here. You own the $100 call, stock gaps up to 110 or some other number.
I love when that happens.
It's not a bad problem, but what would happen if it gapped up to 110 and you're waiting for the opening bell and it's back down to 100 or 99? We've seen that happen.
Yeah. Not only have we seen that happen, it happens all the time, dude. Yeah.
It happens a lot.
Because you're sitting here waiting for the doors to open. You're waiting for the store to open tomorrow at 9:30 Eastern.
Right.
And lots of stuff can happen. You know, they get on conference calls, they start talking about forward motion of the earnings, and bang, all of a sudden, whoof, now that $110 is now 97. And you're thinking, oh man, I missed it.
I missed it. And
Right. Not only did you get hosed on not being able to take an opportunity on the move, but you're going to get now hosed on implied volatility as well. So
exactly
double whammy.
So the question is, how would you lock this in? Now, the basic answer for most people is to short the stock and then exercise.
Oh, wait, I'm not feeling good. What do you mean exercise?
Well, let me show you this answer first, and then I want to hear it from the floor traders.
Okay.
So here's the thing. Here's the way that the few people who would even know this is they'll say, well, I can short the stock. I can get 110. Remember, the market's open in the after hours for stocks, not for options.
Yes, it is till 8 p.m.
Right. So I can short the shares. I've got 110 credit.
Yep.
Now, yes, I do have a short stock position, but on the opening bell, first thing tomorrow, I'll just exercise my call. I'll pay 100, and there I've locked in the 10. Where do I get the $100 from? From the 110 where I sold the stock. It's what's called a self-financing trade. I don't even need the cash for it. Mm-hmm. So we're just going to short the stock and exercise. Now, to a professional market maker, you're probably going to take a different tack. What would you do?
I would not exercise. I would never exercise that option. I would hold on to that option, and I would hold on to the stock. Because I have to, what I'm going to do is I'm going to take a look at the value of that call.
Yep.
At the time when I'm selling the stock at 110, assuming that call is valued at or close to intrinsic value. In other words, there's not a whole hell of a lot left in the extrinsic part of it.
Extrinsic value. Yep.
It's going to be close to or at 100 delta. And when that happens, I now own the synthetic put. For zero. I own a put for zero.
That's what we're seeing right here.
And if the stock happens to go down because they being the marketplace reevaluated the value of the stock and it goes to 95, I get to make another $5.
You get to make,
and I locked in my gain. I would never exercise that call.
Right. That's really the bigger trick for people. Now, the one that I showed originally, to short the stock and exercise, locks in the $10. So
it does, and you're happy, and you go home and you make your money, and you're done.
You would go to this flat line, but when you looked at what Stu was saying, just short the stock and hang on. Now you've locked in the $10, but now you've got this added leg out here where you might make more.
It's an opportunity that you'd be giving up for nothing. So
it's a free lottery ticket.
It's a free ticket. It's a free ticket. I'm all about free,
especially when they can make money.
Yeah.
So that's our little chalk talk for today. We hope that helps. We know we've talked about that with Q&A, and people found it very helpful. So we're going to come up with really intriguing questions for you in the future. So more ways to learn. And I think with that, anything else to add, Stu?
No, just, keep your umbrellas out if it's raining.
That's exactly why we hedge, roll, and morph, and so those will always be
exactly. Just make topics. Listen. Everybody should know where they are at all times. That includes a little bit of prep work in the afternoon, a little prep work in the morning. Take a look at your positions, know what you have, know what your deltas are, your gammas, your thetas, your vegas, know what your crossover points are. Have a handle on what's going on, what your product is, what you're looking for. Set your goals and have a plan. Right? Have a plan. Make a plan. Trade your plan. Execute. And keep it moving. Just keep it moving.
And always make sure that you know where you stand. So hopefully today's presentation for Coach's Corner will give you a better feel and how easy it is to just track your cost basis. And incidentally, if you happen to run into that question at a party, somebody asks you that, at least you'll also know how to answer it. So with that, I think that's all we have for this week, and then we will see you next Thursday. Next Thursday. I believe we're on next Thursday. I know we've got some holidays coming up, but we're on next Thursday, 4 p.m., and we'll look for you then. Thanks so much, everyone.
See ya.